Welcome everybody to Lunchtime Live for FR, for Leases. Thank you very much for coming along. Do drop any questions you have in the chat box and in the comments. Just let me know as well if you can hear me okay and everything's all well technology wise, please. Okay, I'm not seeing any complaints, so yeah, all looking good. All right, so let me crack on. I'll only spend about 20 minutes, I would have thought, of your time, but it'll be a great 20 minutes. 20 minutes, really useful 20 minutes. So the first thing that you've got to know when you're looking at a lease is, seems weird, but is it a lease? Because often in the exam, it will be hidden amongst another contract. So what you're looking for is to be able to identify the asset. So obviously, like, think of it like you're leasing a car. So when you lease a car, you have the right to control that car, don't you? Also, you lease it for a period of time and you don't get it for free. You have to give them some consideration, as it's called. So as long as you've got those three things, you've got yourself a lease. And so lease accounting has to apply, which we'll look at in a minute. Now, that's the general rule. So you're looking for right to control, period of time, some consideration. However, if the examiner says the supplier can substitute the asset, i.e. change your car that you've leased, and they benefit from doing so, then really you don't control the asset, do you? Because they can substitute it, they benefit from doing so, so they probably will substitute it, and so it's not really a lease. So that would be one occasion where it's not a lease. Moving on then, so we said, for it to be a lease, you're looking for a contract where you have a right to control for a period of time and you're willing to pay some cash normally for it. And if a supplier can substitute it for repair, so think about when you lease a car, well, they do that, that's absolutely fine because you still control it in the meantime. Right to control, period of time, in exchange for consideration, they're the things we're looking for, and you make sure that you get substantially all the benefits, the economic benefits for the lease. So the benefits of having the car, you get substantially all of them while you're leasing it, and that you're the primary user of the asset. Okay. Right to control, period of time, in exchange for consideration, you have the right to direct how and why the asset is used. You have the right to drive the car when you wish, how you wish. It's up to you. Then it's definitely a lease. If not, it's not a lease. Okay, so once we've found out that this really is a lease, then we're getting into lease accounting. And I'm not looking at the lessor, I'm looking at the lessee throughout this little presentation. So we've got a right to use asset, the car, and you've got a lease liability, what you have to pay. And the lease liability is the present value of the lease payments. So all your future lease payments, discount them down to the present value, but only those that are not paid at the commencement date. We'll come on to that in a bit. So basically all the future costs. So here's an example. Cow Limited starts a lease on the 1st of January for 3 years. They pay $10,000 a year at the end of each year. So the end of year 1, end of year 2, end of year 3. And we've got to discount those down. Well, I'll discount them down at the rate implicit in the lease. And if that's not told to me, I discount it down at the incremental borrowing rate of the company, which in this case is 5%. I'll not get you to get your calculators out. I'll do it for you. You're at the end of year 1. So you take the 10,000 and to bring it down to its present value, you divide it by 1 plus the discount rate, which in this case is 5%. So divided by 1.05 to the power of how many years you're looking at. Well, this is only 1 year. So that would be 9,524. Payment 2, on the other hand, would be 10,000 divided by 1.05 to the power of 2, because it's 2 years, and that would come to 9,070. And payment 3 would be 10,000 divided by 1.05 to the power of 3, which is 8638. So they're your 3 discounted values. Add them all together. My big ugly face gets in the way, but the total initial lease liability is 27,232, I think. Okay. Hopefully you all followed that. I did it quite quickly, but we'll be doing some more. If you've got any questions, do put them in the comments and I'll get them and I'll answer them. Okay, so 27,232. Debit the asset with 27,232. Credit your lease liability with 27,232. So you're debiting a right to use asset, your car, on the SFP, and you're crediting your liability, what you have to pay back, which is effectively 27,232 in today's money. All right. Now, if only it was just that easy, we'd be okay, wouldn't we? So the lease liability we know now is the present value of the lease payments that are not paid at the commencement date. Those 3 lease payments were paid at the end of year 1, year 2, year 3, so they weren't paid at the commencement date, so we included them all. What you'd also include, though, is if there's any residual value. All of these, before I go into these actually, all of these are basically, is there any reasonably expected future costs apart from your lease payments? So maybe you're guaranteeing the residual value and you think you're going to have to pay that. Well, you bring that in then as a payment and discount it down. If there's any reasonably certain purchase options at some stage, as long as they're reasonably certain, then you bring them in and discount them down. If there's any expected payments for terminating the lease, you bring them in, you discount them down. So any future payments you discount down. Got it? Good. Okay, so what about the asset then? Well, we know the asset started off, didn't we, with the present value of the lease payments, because you work that out, you debit the asset, credit the lease liability. The extras that go on, if there's any upfront payments, any payments at the commencement of the lease. The lease liability is payments not at the commencement, but afterwards. If there was one at the commencement of the lease, you add it to the asset. Any initial direct costs, such as legal fees, any dismantling costs in the future, bring them in at the present value. And you take away, which is why I put it in grey there, you take away any incentives they gave you to get in the lease. We will do an example on that. So on our right to use asset we had before, if you remember, there's 27,232, debit, asset, credit, liability. But if we get told that the cow company also paid legal fees of 1,000, initial direct costs, and they also received an incentive in cash from the lessor of 500, well, they affect the asset. So the asset would be in at 27,232 plus the initial legal fees, that gets added to the asset, less any incentives we've received. So the right of use asset at the end would be worth 27, not 232, but 27,732 because of the legal fees and the upfront cash that we've received. Now, what would the double entry for all of this be? Debit the right of use asset with 27,732. The liability, if you remember, was 27,232, and the direct costs and the incentive received, they net off in cash to be 500. Simple as that. Hope you're following and are okay with it. Thank you very much, Noah. That's nice to know. So we've got a right to use asset and a lease liability. The right to use asset was in at 27,732. The lease liability was in at 27,232. What you do with the right to use asset is once you've worked out the value at the start of the lease, then you just depreciate it over the length of the lease term. So over 3 years, going to your income statement would be 9244. Nice and straightforward for the asset. Not so nice and straightforward for the lease liability, though. You have to use amortized cost, and this is where the examiner says things get a little bit tricky. So let's do that amortized cost table then for the lease liability. So we open up at 27,232. Now, we charge some interest. If you've got a lease, you're going to have to charge interest. The interest is the discount rate. So you discounted it down at 5%. You what we call unwind at 5%. You charge your P&L with 5% interest, and that is 5% of the 27,232. So that comes to 1,361. Then at the end of the year, you make a payment, and that will leave the closing figure on your balance sheet, on your SFP. So you'd have an interest charge of 1,361 in year one, and you'd have a liability at the end, a lease liability at the end of 18,593. Then year two comes along, you charge 5% interest on the 18,593 to the income statement. At the end of the year, you make your payment. Say your closing balance on your SFP is now 9,523. And then year three comes along, the final year, you charge 5% of the 9,523, that goes to your income statement, you make your payment, and then you get a closing balance of 0 because there's nothing left. That little 0.55, whatever it is hidden there, is just a rounding thing. Okay, so that's a lease liability when the payment was in arrears, when the payment was at the end of the year. Okay, so what about this one? We lease an asset for 3 years, same as before. We pay 10,000 at the start of each year, the start of year one. And do you agree the start of year one is the commencement date of the lease? So we said that the present value of the lease payments are those after the commencement date. So the first payment we can ignore as far as the lease liability is. What do we do with that first payment? Can you remember? Any upfront costs at the commencement date, not included in liability. We add it to the ROU, the right of use asset, don't we? So the first 10,000 gets added to the asset, debit asset, credit, cash for 10,000. So I've got 2 payments left, and I'm trying to work out my lease liability. Discount rate is 5%. So my second payment, which is the first payment for my lease liability, it's due at the start of year 2, which is effectively the end of year 1, isn't it? So I take the 10,000 and I discount it down by 1 plus the interest rate, 1.05, to the power of 1, because even though it's the start of year 2, that's the end of year 1, it's been a year. So I just discount it down for 1 year. The final payment is due at the start of year 3, which is effectively the end of year 2. So the present value would be 10,000 divided by 1.05 to the power of 2, because it's in 2 years' time, effectively. Add those two together, and you get your lease initial liability of 18,594. Okay, so let's put all that together. The right to use asset, 18,594, debit asset, credit lease liability. But remember, we had this upfront 10,000. When you pay in advance, you pay on the commencement date. That goes to the asset, doesn't go to the lease liability. So you've got 28,594 asset. What do we do with that? We depreciate it over the 3 years. The double entry then would be debit right of use asset, 28,594. My lease liability, as we calculated, was 18,594, and the rest was cash payment that we made. Okay, so it all fits together nice and straightforwardly, I hope. Hope you're still with me. I know there's a lot of numbers, etc., but it seems to be that you are, so that's great. Keep going then. Here's the lease liability, and can you see, because it's in advance, I have to change my amortized cost table. I have to make it 5 columns, and my first entry in year 1 is not the opening, but it's the balance entry. Just remember that. Interest was 5%, so 5% of 18,594, and my closing lease liability would therefore be 19,524 at the end of year 1, and my interest charge in my income statement would be 930. Year 2 comes along, we open with 19,524, but remember this is a payment in advance, so immediately I take off 10,000, because payment at the start of the year. That leaves me with 9,524. I get charged interest on that at 5%, which goes on my income statement. Add that, and I get a closing of 10,000, closing lease liability. Year 3 comes along, I open up at 10,000, I pay the 10,000 immediately. I've got nothing left, no interest to charge therefore, and no closing balance. So we do put these videos back on YouTube at the end, so you'll be able to watch this again and get good at this. Get good at the in arrears table, the in advance table, which is harder than the in arrears table, really. Okay, so that's lease accounting done. The exemptions are, if it's a really short-term lease of 12 months or less, and there's no purchase option in there, or if the lease is of a low value asset, and I mean low value when new, and in the standard, it's not explicitly mentioned, but it is in the helpful material. It suggests around $5,000 or less. So if it's a short-term lease, or if it's a lease of low value asset, then what you're allowed to do is ignore everything I've said and just put it into the P&L on a straight line over the lease term. Simple as that. So they're the two exemptions. Common errors then, according to the examiner, we're nearly there now. Payments in advance, as I said, that's the most frequent error that the examiner always mentions. So get good at it. Don't be like everybody else. Calculation errors in doing the present values, in doing the depreciation. Not showing your workings. If you don't show the workings and you get the answer right, fine. But if you don't show your workings and you get your answer wrong, you'll get no marks. Whereas if you've shown your workings, you might get a couple of marks. Not reading the question. So what's really important is you make sure you think to yourself, right, stop. Is this in advance or is this in arrears? Because as you can see, it makes a lot of difference. Did I put the initial direct cost to the asset? The lease incentives, did I take them off the asset? Excuse me, have a drink. Okay, so just things to be aware of, really. Some key pointers then. Just be aware that the lease term isn't always just what it says in the lease. We've been doing 3-year leases, but that might change. You might have an option to extend it to 5 years. Well, do it over 5 years if you're reasonably certain, if the examiner says they are reasonably certain to extend it. Or if they're reasonably certain to shorten it, then do it on a shorter term, but only if they're reasonably certain. Initial direct costs, what do we do with them, folks? Added to the cost of the asset, so legal fees, that sort of thing. Lease incentives, what do we do with them? Take them off the cost of the asset at the beginning. And just be aware, they may say, oh, come into this lease and we'll give you a rent-free period or we'll give you lower rents. Don't take the value off the asset because it will automatically work itself out in the present value of the future lease payments. The present values of the future lease payments will be less, so your asset will be less automatically. So just be aware if the examiner tries to trick you there. Okay, that is it. That's 20 minutes, as I said, of your very valuable time. I hope you've enjoyed it. I hope you've got something out of it. I really do. I am aware that taking your time is a big thing, even though it's free. So I do thank you for coming along. If you enjoy it, do come and see us at aCOWtancy.com.